In the previous episode, we talked through this whole AI boom. And as you remember, I came to the conclusion that these valuations can be rationally defended. Alright, but that's the theory, and reality is a different story. Because right now, the most important question is, what am I actually doing about it? Knowledge that just sits there and doesn't translate into any decision is practically useless. But on the flip side, acting without a plan is the best way to shoot yourself in the foot out of sheer stupidity. So before I buy anything, I'll show you how I'm breaking it down today. The status as of right now: a clean slate, 100% cash. The capital is just sitting on the sidelines. And honestly, I know what you're thinking right now because I catch myself doing the exact same thing. You watch the market go up, and a voice in your head screams that you need to buy something, that every day without a position is a loss. Man, that's the hardest part of all this. But this is exactly the moment when people most often do something stupid. There's hard data on this, I'm not making it up on the fly. Investors who trade the most frequently underperform by about 6.5 percentage points a year, compared to those who sit quietly and don't click every 5 minutes. Commissions, spreads, and our overconfidence in our own ability to time the market. Clicking buy and sell frequently doesn't mean you know better. It often just means your emotions are getting the better of you. So remember one thing: not making a decision is also an investment decision. And believe me, very often it's the best one available. Especially today, with the interest rates we have, that cash in a savings account or a money market fund is also earning something. Waiting isn't doing nothing. It's simply maintaining your flexibility and, just as importantly, your peace of mind. Just don't get me wrong. This isn't a forever strategy. I'm not planning to hold cash forever. It's a deliberate pause before the first move, which, by the way, I'll share with you. But before I make a move, I need to know what to actually look at to understand what phase of the cycle we're in. So instead of immediately clicking buy, I'm building a watch list. I have two buckets on it: places where I'm looking for profit, and what I call risk sensors, meaning things that tell me when to be careful. Let's start with that first part. First up are the absolute classics, nothing groundbreaking. The ticker CSPX, which is an S&P 500 ETF, CNDX for the Nasdaq, and DAXX for the German DAX. I hold the latter mainly to keep an eye on what's happening in Germany because it's a major trading partner, and when something starts happening there, it eventually ripples over to us. When picking an ETF, I keep an eye on three things. They sound trivial, but these are exactly the kinds of details that can easily burn you later. I start with the TER, or the total expense ratio. Believe it or not, the difference between 0.1% and 100th might seem cosmetic, but compounded over 20 years, it eats up a chunk of your capital that could have kept working for you. Next is replication. I prefer the fund to physically buy the stocks rather than play around with derivatives, even if the synthetic version is sometimes slightly cheaper. And third, accumulation, meaning automatic dividend reinvestment, because it's simply more convenient and more tax efficient. The three funds I mentioned earlier check all these boxes without major compromises. It's just a shame that EU regulations don't allow us to normally buy those American giants where costs are practically zero. But we play the hand we're dealt, and these cards are actually pretty good. Besides the classics, I have my eye on two Asian markets, and I bet that will surprise some of you. The first is Japan, ETF XDJP. For decades, a country synonymous with stagnation, home to zombie companies where mountains of cash sat idle in accounts. Over half the companies were valued below their book value. But in 2023, the Tokyo Stock Exchange said enough and forced boards to start caring about shareholders. It worked. By the end of 2024, over 60% of companies adapted to the new rules. And Buffett has been buying up Japanese stocks for years, praising their valuations. When someone with 60 years of experience looks that way, it's worth considering what he saw there. Another direction, Korea, ETF CSKR. Here we have the Korea discount, valuations weighed down by family-run chaebols. I admit, when I first saw these valuations, I thought I was missing something. The government launched a corporate value-up program modeled after Japan. But there's something else. AI isn't just NVIDIA, it's also HBM memory, and that market is ruled by SK Hynix. If the reforms actually work, you could see valuations improve while simultaneously riding this whole AI wave. That's what interests me the most there. Now the second layer, meaning my personal early warning system. Gold, which I track via SGLD, is the best stabilizer for me because there's no issuer risk. No central bank can destroy its value with a single money printing spree. I also check Bitcoin, although I don't invest in crypto myself. I just treat it as a sensitive barometer of risk appetite because historically it has reacted ahead of the stock markets. When the Nasdaq is breaking records and BTC drops 40% from its peak, that's a red light for me, even if not every signal like that plays out. On top of that, the VIX, the stock market's fear index, below 15 points, everyone is calm, sometimes even too calm. Above 25, things get jittery. And finally, two commodities, copper and oil. Copper, the famous Dr. Copper, tells me if factories around the world are actually running, and oil is a leading indicator of inflation. To me, these are hard facts from the real economy that no market sentiment can replace. So today, my list is ready. Growth engines on one side, risk sensors on the other. For now, I'm sticking with cash, no open positions. But this map is just the first step. In upcoming episodes, I'll put this tool to use.